Welcome back to the Legacy Radio Network. You're listening to Everything Financial Radio, and I'm having the distinct pleasure of chatting today with economist Harry Dent. Harry, I want to shift gears a minute because in the last segment we talked a bit about demographics. And let me ask you a question. If you were going to give career advice to a young person today based on your demographic research, someone just entering college, training for a profession, what would that advice be?
Well, again, take into account these swings in the economy. We think that the stock markets and the economy is going to get worse for the next few years before it temporarily gets better. It's better to finish your school. I'd say you want to graduate in the spring of 2015, whether you got to go to summer school to accelerate that or whether that's your natural cycle. Get your schooling done while the economy's down, and then get out there and push hard for jobs. It's still not going to be easy, but we should have another rebound, 2015, 16, 17 or so, and that get in the workforce, get a good job or start a business. What are you going to do? But solidify your position, because it's going to be a difficult time for the next decade. You're growing up, if you're young, in a difficult decade, just like the Bob Hope generation did in the 1930s and the baby boom in the 70s. And so you need to look for job security and get the right skills, get practical skills. This is not the time to get a major in English.
In one of your recent newsletters to financial professionals, your colleague Rodney Johnson noted the economy has been shedding higher-paying jobs and replacing at least some of those lost jobs with lower-paying jobs. It was a pretty disturbing trend. Can you comment on that, and to what do you attribute that?
Well, it's just downsizing and cost, cutting costs in a down economy, competing with, emerging countries overseas that have lower wage rates. Now, the flip side of that is the people who have college degrees, kind of the top 20% of households and income earners, their unemployment's 4%. They are not getting laid off. Another thing that young people have to worry about, baby boomers who thought they were going to retire at age 63 on average are now staying in the workforce longer because their savings have been demolished and the economy's weaker, so they're going to have to work longer. That makes it harder for young people to get jobs, especially the good ones, because people are going to hold on to those jobs. So but education, strong education, is your best weapon. If you've got low education, it's only going to get worse. Wage gains have been minimal in the boom for people with high school degrees and things like that, and they're the people who are seeing these lower price job. When they finally do get rehired, if they get laid off, they tend to have to take a lower wage. That's not happening as much on the higher end with people with high education.
Harry, in the time we have left, I want to chat with you a bit about politics, since we're in an election cycle here, and then I want to talk to you a bit about investing. Since we are currently in the midst of an election season, there's much talk about getting the federal deficit under control. The math is pretty clear in this area. You cannot address the deficit without addressing entitlements like Social Security and Medicare. Can the increasing costs of these programs be addressed without a significant negative impact on the economy?
No, it can't, number one. And number two, nobody's got a plan even close. Even Paul Ryan's plan is not even close. The cuts are too far down the road, and they're overtime, and they're minimal. I mean, I hate to say this, but we've got $66 trillion, more than all our private debt and our government debt put together, in unfunded commitments for, entitlements for Social Security, Medicare, Medicaid. And now that's over 4 decades, so that's not as immediate problem as the private debt that's deleveraging. But it's not something that's sustainable, not even remotely, especially as demographics slow, and the next decade is particularly slow. So we're going to have to let me give you a quick example. If we had simply indexed Social Security to rising life expectancy since it was started in 1939, we'd be retiring at 75 instead of 62 to 65 today, and we wouldn't have a Social Security deficit. So we're going to have to make enormous changes. It's politically unacceptable for any. Even Romney says last night, we're not going to cut any benefits for older people now. Hey, wait a minute. You can't let all these older people have all their benefits forever and keep pushing the burden out to younger people later. So when the economy crashes, I think the good side is we're going to get a crisis. People are going to realize, just like labor unions do when their companies go down and they're bankrupt, that their benefits are not sustainable, and people are simply going to have to restructure to retire later, to have Medicare, Medicaid benefits kick in much later, and they're going to have to be cut back to something more reasonable. Everybody can't have unlimited health care. It just cannot happen, and you cannot work 26 years and then retire for 23 years. And that's the present cycle as our life expectancy has gone up. It's just, we need a total reset on retirement. Retirement is an illusion. It never even existed before the 1930s. And in emerging countries, nobody ever retires. We're going to have to go back closer to that, or at least retiring with maybe a 10-year life expectancy instead of a 20 to 26-year life expectancy. That's absurd to play shuffleboard for 26 years.
That's a great answer, Harry. And, I want to, a lot of folks maybe listening to the presidential debate this past week may have realized that, there's a lot of talk about the deficit. Could you comment on to what extent is the federal deficit and debt a real drag on the economy?
Well, it is, and this is around the world. I mean, people show that when your debt gets to 90% or higher percentage of GDP, it can slow economic growth by 1% or more. Well, every major country in the world has that or more, and our private debt is 3 to 4 times GDP. I mean, it's absurd, and in a slowing economy, this is where I disagree with the politician. You cannot grow your way out of this. You have to restructure debt. You're going to have to cut government expenditures, you're going to have to raise taxes selectively, and private debt's going to have to be massively written off and restructured as it was in the 1930s. I mean, 1930s was a horrible crisis, but people don't realize our debt to GDP for the entire country went from 190% down to 50% in 3 years. That was a huge burden lifted off of consumers and businesses, and in a period of slow demographic growth ahead, the only way to get consumers and businesses going again is to lift debt. Everybody borrowed too much. Home prices and things that were borrowed against went down. So we've got to restructure debt. That means banks got to take hits and government's got to support banks that write down debt. But government's giving free money to banks that are doing nothing but speculating and keeping themselves alive when they need to be serious about writing down loans. That's the only thing that's going to help businesses and consumers. That's the upside to this crisis, is that we're going to get up to $20 trillion in private debt liftoffs coming. Now, think about that, $20 trillion. That's about $1.5 trillion a year in principal and interest that will pay off for years and decades to come. Now, that's a stimulus plan that works. I don't understand why nobody can figure out the simplest, most obvious thing. Restructuring debt is the only thing that will give a boost to our economy long term, and is not just another short-term fix that wears off next year.
Great answer. Harry, I want to shift gears and talk a bit about investing. You advise both consumers and financial professionals in this area. If someone is retired today and they want to protect and grow a nest egg, what should one be doing? And let's talk about forecasts for, say, stocks to start.
Well, first of all, and we're always guessing in the short term. I mean, we could predict the top of this market 20 years ago, but in the short term, I'm making like a 60-70% probability guess. I think with QE3, this recent announcement and all this stimulus here, stocks are going to go up a little more, not nearly as much in past stimulus. We see the Dow going up to something like 14,600. That's about 8% from here. And then, as every bubble has in the past, the market goes to new highs and then it goes to new lows. We see it crashing to 6,000 or a bit lower just in the next few years by late 2014. So I'd say by late this year, early next year, 14,600, and then a 60% plus crash. So obviously 8% on the upside, 60% on the downside. That's not a good thing for investors, and you certainly don't want to buy and hold. You can be in stocks now, you can increase allocations, but I would be pulling them back, getting out of stocks in the next 2 to 4 months, two to maybe even 6 months. And then, you can either be in cash, earning nothing, letting everything fall, and then rebuy when stocks crash 50, 60% or more, which is a huge bargain, and there'll be another bull market to follow for 2 or 3 years. Or, if you're more aggressive, you can actually bet on some markets going down. If you want to bet on the S&P 500 going down, you buy SH. It goes counter to the S&P 500. So if we have a 50-60% drop, maybe investors want to be mostly in short-term safe cash, 3 to 6 months from now, but maybe they want to be 20-30% short the stock market just to basically build some gains and to benefit from the downturn.
So Harry, if someone's got a 401k, they're 58 years old, they've got their nest egg in the 401k, they can't distribute it, they're not at 59 and a half. They have the traditional plain vanilla choices of a stock fund, bond fund, or some variation thereof, or cash. Am I hearing you saying they should be in cash?
Yeah, I want the cash or a short-term bond fund. I do not want a long-term bond fund because in a crisis, default risk goes up, interest rates spike, for a while, and that could hurt you as well as stocks. So you short-term bond fund or cash.
Give us your take on gold. It seems like everywhere you look, there is a new company popping up that wants to help you buy hard metals in your IRA. What's your take on gold moving ahead?
Well, number one thing is just like real estate and tech stocks before it. When everybody's buying something, you got a bubble that's going to crash. Gold is an inflation hedge, not a deflation hedge from history more. So I think gold's in a bubble. Silver, we already got people out of silver in April of last year when it hit almost $50. I think gold is going to rally with QE3-like stocks. I mean, stimulus is, something gold likes. Okay, this is inflationary down the road. This is bad monetary policy. So I think gold probably goes back over 2,000 a bit, and then it crashes over the next several years. So I like gold short term, like stocks, but I do not like it past the next couple to several months. And if gold does go over 2,000, I would say take your profits and run. Or you can always keep a little bit of gold or silver as a hedge or something, but I would take my profits and run, just like we did with silver at $48.
Harry, give us your take. I know the Fed has been tinkering around in the government bond market. Now they're buying mortgage-backed securities. But what's your outlook for U.S. government bonds? Is it, as Dr. Gary Schilling says, going to be the safe haven when Europe blows apart?
It was when everything crashed in late 2008. Gold and silver and oil and stocks around the world, most things went down. The only thing that went up was the U.S. dollar relative to other currencies and U.S. Treasury bonds. This time, I think it could be different. I don't like Treasury bonds. They've already gotten to record lows, 1.4% on a 10-year Treasury recently. We have a kind of a channel that says, when we hit the bottom of this channel, which would be about 1.2 to 1.3%, if we get that low, I would sell Treasury bonds, because I think the next move is that investors have been fleeing into bonds as a safe haven. U.S., Germany, England, countries like that. None of these countries are safe. They got huge debt problems. And credit quality, we're going to see credit downgrades in the U.S. government in this next crisis. And I think Treasury bonds could temporarily go from 1.4 to give or take here, back up to 3.5%, 4%. Then you could buy them, because eventually deflation is going to take interest rates right down. But I think Treasury bonds may not be the safe haven in this crisis. I like the U.S. dollar. There's an ETF called UUP that we've had people in over the last year. If the U.S. dollar goes up versus other currencies, it goes up. It was the best single protection against the crash in late 2008. So we have another crash. You can be in cash. You can be in short-term bonds. You can also be in UUP. And you can also be short stocks like SH. So that's the type of ways to play this for an everyday investor.
Economist Harry Dent, thank you for joining us. We appreciate your time.
Okay. Thank you, Dennis.
Everything Financial Radio will return after these words. Stay with us.